Let's start with the big news of the week, perhaps, came on Friday with those jobs numbers where people were a bit disappointed in the overall number, but there were a lot of other numbers in there that suggested we've got a pretty robust labor market.
This was a strong report. After this report, the vacancies to unemployment ratio is going to be higher than it's ever been. We saw wage growth at rates, depending on which measure you used, 7 to 8% annualized rates in the last month. And if you look at the sequence of reports, it's been accelerating. The establishment number was disappointing, but the previous months were substantially revised upwards, and I suspect this one will be as well. I don't think anybody can look at this labor market and this jobs report and believe that we have a sustainable degree of heat in the labor market. The level of heat that we have in the labor market is consistent not just with high inflation, but is consistent with accelerating inflation. And there isn't going to be a path to less inflation without a cooler labor market. And I think that has to be sobering.
So, Larry, last year, the Fed seemed to be reassured, at least for part of the year, that there was some slack in the labor market that would absorb some of that inflation. Is there any doubt in your mind right now that we're in full employment? Because we not only had these numbers, we also had the JOLTS numbers come out, and boy, we're record numbers of quits.
David, I've been doing this long enough that there's always doubt in my mind. Nothing is certain, but the probability that we are past a sustainable level of heat in the economy is higher than I can remember it at any point in 40 years that I've been watching these things. I think that the Fed is recognizing that, and that's why they've executed in the last 3 months such a strong pivot from talk of transitory inflation and the need to ensure employment targets and the need to guard against deflation, which was their rhetoric just a few months ago, to a focus on inflation now, to accelerating the tightening, to signaling the very real and even likely possibility of rate increases in March. We are well into the adjustment of monetary policy. My own view is that the Fed and the markets are still not recognizing what's likely to be necessary. The market judgment and the Fed's judgment is that you can somehow contain this inflation without rates ever rising above 2.5%. In terms of the Fed funds rate. I don't think that's very likely to turn out to be right. And if it does turn out to be right, it's only because the economy is extraordinarily vulnerable to rate increases, which will mean problems of its own. So I think we're headed into a very challenging period for the Fed in terms of executing a soft landing. It looks to me like we're going to need some meaningful deceleration in nominal wage growth, not necessarily in real wage growth, but in nominal wage growth. And if we don't have much experience of getting such decelerations in nominal wage growth without a substantial, well, at least some slowdown in the economy. So orchestrating the turning down the temperature in the economy, I think, is going to be very challenging from here.
Well, let's pick up exactly on that point, orchestrating this cooling down, because we also had a piece of news out that the market certainly reacted to this week, which is the Fed minutes from the December meeting, in which they said not only are we going to talk about tapering, we might well have rate increases more and sooner than we thought. And by the way, we might get to quantitative cutting, actually. We're going to actually tighten the quantitative easing instead of just tapering. Is that enough? And by the way, can they do all of that stuff in the time allotted?
David, they can make the choices that they want to make. Certainly, there have been periods when the Fed was raising rates 25 basis points in a given at every meeting for periods of a year or more. So it's certainly something that is technically possible. I think what we're going to find out is what the vulnerability of the economy is to rate increases. If that vulnerability is not greater than it has been historically, then it's really quite unrealistic to think that we're going to keep inflation under control with 2% rates. It may be, as some argue, that because of greater levels of debt, because asset prices are substantially inflated, the economy is more vulnerable than usual to rate increases or to quantitative tightening. So it's not an easy balance that they're going to have to strike. My guess is that we're headed into a difficult period because I don't think that inflation's likely to come down very quickly. And indeed, it's almost baked in that the annualized inflation figures are going to be rising for the next several months because of the very flattering compares or very low compares in January and February of last year. So my own sense is really of the difficulty of this, and the challenge for the Fed is that they're likely to see some amount of fluctuation in financial markets and concern about growth before they see the declines in inflation that are substantial. And then they're going to have a very difficult set of decisions to make.
So Larry, finally, we're looking forward next week to the confirmation hearings for both Lael Brainard and Jay Powell on the Fed. And we also have nominations coming up from the White House for other positions there. At the same time, we're getting new information about some of the trading in the markets by some of the existing members of the Fed. The most recent one coming out this week, actually, with respect to Rich Clarida, somebody you and I both know well. We don't know all the facts about it. You don't know it. I don't know it. But what's your reaction, basically, to the question of members of the Fed and their participation, what they should be doing, what they should not be doing, what they should be disclosing?
Look, I don't know all the facts, and it's a grave mistake to judge people based on press reports, and I'm not going to do that. I do think that it should be inconceivable that in a period of market turbulence where the Fed is contemplating major action, that a Fed official would trade in one direction and then 3 days later trade in another direction on a 7-digit scale. That should be inconceivable. Again, I don't know what happened, and I think it's important to recognize that Chairman Powell has moved aggressively to put in place new rules. And I think those new rules are really quite rigorous with respect to what the Fed does. I think we need much more rigorous rules for everyone who is serving in the federal government. We had an outrage of the week here on the show 6 weeks or so ago about trading in the House of Representatives. And I think we need to have very rigorous rules, and that's something that needs to be looked at very carefully.